Gold futures, though, did surge again today to yet another record intraday, topping $1,800 an ounce. Jay Taylor is the president of Taylor Hard Money Advisors. He joins us from Vancouver for a closer look. How you doing, Jay?
Doing well.
I can imagine, particularly at $1,800 at which we flirted today. Now this has got us talking about not just a gold bubble, but also the prospect for even greater gains for bullion. Where do you see it topping out?
Oh, you know, it's really difficult to say, and I don't think we're in a gold bubble at all. I think what the bubble is in the bond market, in the paper market. I think people have to get used to thinking in terms of gold as money, not paper, not dollars as money, because how can you measure something in dollars when there's endless numbers of new dollars being created? It would be like, you know, using a yardstick and taking an inch or a few inches off the yardstick every year and trying to claim that that is a valuable unit of measure. So the dollar is not a unit of measure. I think gold isn't gaining. It's that the currencies are being trashed. We're deficit spending, of course. We're stimulating the economy by trying to create wealth by printing money. I mean, it's a fallacy. It is not working, and I think what the gold price is saying is that the monetary system is really breaking down right now. So where is gold going? You know, it really depends. I like to measure gold relative to the Dow Jones, for example. And we know over the last 100 years or so, at the real bottoms of secular bear markets, we've seen the price of gold or the ratio of gold to Dow be about a 1-to-1. So I don't know if that's going to be 5,000 and 5,000, 10,000 and 10,000, or 1,000 and 1,000. It depends on whether the system deflates, and we are in a massive credit deflation right now, a deleveraging of the system, which has got way too much leverage. It cannot, the debt cannot be repaid, so Mother Nature is going to make sure that the debt gets wiped clean, and in the process it's extremely painful, and what we're seeing is an adjustment, and people who understand that the system is in trouble are buying gold, and that's how they're protecting their wealth. Otherwise, if they buy you know, financial assets, for example, and we go into a deflation as we are, your money's at risk in the banks, because the banks have horrible balance sheets and they've got bad loans. If we hyperinflate, you know, then the value of what you own, then tangible assets of all manner will preserve some wealth. And so I think that's why gold is going up. So to ask where the price of gold would go, I think I just don't know, because I can't predict how thoroughly people will lose confidence in the dollar.
Well, give me some insight then as to why, while Mother Nature has been guiding its child of gold higher, why the unloved child of gold stocks seem to be ignored at this point. Why aren't they moving lockstep, Jay?
Well, I think they're not moving lockstep in part because gold shares are a much more difficult thing to analyze, to understand. And most people, let's face it, have not been gold investors. I live in New York, and if I were to walk down the streets of New York and find 1 in 100 people that are really enthusiastic about gold, I would be surprised. People, and especially gold shares. Now, they're buying the ETFs. That's an easy one. You can just get in and out of the ETFs. I use the GLD myself as a sort of a cash account, honestly. And so when I want to build cash, I put it in GLD, not dollars these days, and then I can get in and out. It's a very liquid asset. So you can buy gold, and people feel like they're being hedged with gold. But honestly, the real big money is going to be made in the junior mining companies, I think, the ones that find the gold. And what we are seeing now is we're seeing the major gold mining companies start to react much better. Newmont, Barrick, and some of those, I just heard some quotes a minute ago, doing very well now in a very bad market. So, and the profits for those companies have been extremely strong, very robust, and they're very robust because the real price of gold has risen very dramatically, and this is traditionally what happens in a credit contraction, a massive credit contraction, a global credit contraction. The real price of gold, what an ounce of gold will buy relative to other commodities, goes up very dramatically. We saw it after the Lehman Brothers. After Lehman Brothers, gold went up. I like to measure it against the Rogers Raw Materials Fund. We had an ounce of gold in July of 2008 would have purchased only 17% of the fund. By March of 2009, it would have bought 44%. We came back a bit. started going back up with the Greek crisis, and I checked on Monday after the carnage of Monday's market, we were at 46.5%. What that means is that an ounce of gold will buy more copper, will buy more steel, will buy more energy, will buy more food, will buy more wool and cotton, and it'll buy everything more. So that is very good for the gold mining profits. They're surging right now. The senior mining companies, the problem with the senior guys is they can't replace their resources. They can't replace their reserves. So what they're doing is going to the junior mining companies, the kinds of companies that I come and visit here in Vancouver, and this is where I think the real big money is going to be made, because the seniors got to go out and pay $700, $800 sometimes per ounce of gold in the ground. The juniors that find it are finding it for $10, $15, $20, $30 an ounce. That's their cost. So, and Vancouver, the Canadians are really the best in the world at finding and exploring for minerals, and that's why I, as a New Yorker, am up here in Vancouver right now.
Well, Jake, good to have you with us, and the only thing about the conversation that really struck as odd to me is the idea that you could stop 100 New Yorkers on the street to find out that one of them liked gold. I don't buy that for a second, my friend.
Oh, I think that's in terms of gold mining shares. You know what? I'm going to test it.
Good to have you with us, Jay. Thank you.
Thank you.
Jay Taylor, president of Taylor Hard Money Advisors in Vancouver.